Hey everyone, I have a really exciting stock pick I want to share with you today. This is a Dividend stock, and it is a stock that I do not own yet, but I have been tracking for some time, and it actually came from this community. It came from a member of our community, and this is one of the reasons that I started this YouTube channel, that I have built this community, because there's a lot of collective intelligence here amongst all of us. So shout out to my friend Sam. I had the opportunity to meet Sam several times now at various PPC and meetups before the pandemic, and he shared this stock with me. I look forward to analyzing it today, but in terms of finding this stock pick and surfacing it, all credit goes to my man. And I love this concept of the hidden gem. It's actually something that attracted me to dividend investing in the beginning. And I tend to think sometimes that the best dividend companies, or a lot of really great dividend companies, they fly under the radar. There are these quote unquote sleepy businesses. They're businesses oftentimes that you or we never really heard of or really thought of, but then when it kind of surfaces, we're like, oh yeah, I do know about them. But they kind of fly under the radar. And it's so cool. I love these companies that fly under the radar, so to speak, because oftentimes they have very defensible businesses. They have very much thriving businesses. They're businesses that are able to extract really good margins, that are able to increase their dividends over time. And so I'm going to share one such business today. And it's so funny. It's often the Peter Lynch investing strategy. One of the best strategies is just to go around and look at the products that you consume, that you utilize on a day-by-day basis, and just see who makes them. Because I would have never guessed. I use these products all the time. What I have right here is a canister here of the DAP Quick Seal. This is the caulking that you can use like in your shower or bath or your kitchen area, really to seal the joints between where the tiles meet, to protect it from water intrusion. And this particular one, this DAP brand, is the brand that I always use. I always use it. And I use DAP, quite frankly, for my spackle as well. If I'm ever patching up a wall and then painting, I use the DAP brand of spackle as well. And it's interesting because when you look on something like this, when I look at the back of this DAP canister, it just says, hey, it's made by DAP Products Inc. And I never really looked further. But what Sam pointed out to me is this is actually a product that is owned by a company called RPM International Inc., ticker symbol RPM. And this is a publicly traded company. It's a company that pays a dividend, that has increased its dividend many, many years on end, and they have really good financials. And so I'm going to go into RPM today. I want to do a dividend stock analysis. I want to share with the community my thoughts on this stock, and I would be curious if any of you own it out there. Put in the comments below, because again, this is a stock that kind of flies under the radar. I don't hear about it very much. So get ready, everyone. Maybe this will be my 47th dividend stock. You never know. We'll see by the end of the video today. So let's get started with another dividend investing video. All right, everyone. So I want to jump right into it as always. I'm just going to go through a quick summary of what I learned about RPM International from their investor presentation and from their website. And then I'm going to jump into some extensive financial analysis. So check it out on the screen right now. And what you see is just a quick overview. RPM International makes specialty coatings and sealants. I know them really well for the DAP brand, but they have many other brands you may have heard of, such as Rust, Oleum, Varathane, Crud Cutter, Drydex, Quick Seal, Plastic Wood, just to name a few. Now, obviously, these products I'm listing here are consumer-facing products, but they also make products that go directly to building contractors, for example, that may not go by names that you or I readily recognize unless you are in the construction industry. We'll get to that in a minute when we go through the segment by segment breakdown. One of the things I love about this company is actually the second point here. They allow people to preserve real property. I work in the real estate industry, commercial real estate. I'm a homeowner. I take great pride in real property because in a world of inflation, in a world where really paper currency can just be printed times infinity, there are certain things that you can't make more of. And one of those is land and real property. I guess unless we go to another planet, but on planet Earth, there is only so much real property, and especially in really good locations. And so what do I like to do with real property? I like to preserve it. I like to keep it in tip-top shape. I like to use products like the Quick Seal, quite frankly, to keep those joints in the shower sealed and safe from water intrusion. And these are the types of products that this company RPM sells. And so I think they're fulfilling a wonderful mission by providing products that literally protect the exterior surfaces of real property. So that really, really resonates with me, especially being in the commercial real estate space. So what else? Here's just a unique business line. They mentioned on their website that they provide a lot of epoxy products and also flooring related products. And one of the products they were highlighting was a warehouse flooring, and it looked like a really cool epoxy flooring that is used in large warehouse applications. And I don't know about you, but where I live in the greater Bay Area, in some of the cities just outside of the Bay Area, near major freeways, there is a ton of large warehouse space going in. And a lot of the warehouse space is being consumed by companies like Amazon. And so I'm thinking there's kind of this macro trend probably away from certain brick and mortar stores, but more towards direct to consumer, direct fulfillment. And what do these direct to consumer companies need? They need industrial space. They need warehousing. And so it's really interesting to see that RPM fulfills that need by providing products to help outfit the warehouse. So I thought that was really, really cool. What else? Hey, this is a channel about dividend stock investing, and so it was really cool to see that they have raised the dividend by 46 consecutive years. And so pretty soon here, this company is going to potentially be a dividend king. And so I thought that was really cool. And they are already a dividend aristocrat based on that 46 consecutive years of dividend increases. So really cool to see that. Now, they have this thing about their culture that I thought was cool. I guess the founder of the company came up with something called the value of 168. And I was looking that up. What's this? And basically what he was saying is there was 168 hours in any given week. And so he really hammered home to the employees, we ought to prioritize our time. Time is limited. We can only do so much with our time. And so we got to think very critically about our time. And from a culture perspective, I really like that because that's how I personally live as a business person, as an entrepreneur. There are only so many hours in the day, and the hours oftentimes run out. And so I have to prioritize. I have to be efficient. I have to make trade-offs. And I've actually on my private Facebook group, I'll link to it in the description below. Check it out. I recently had a conversation with everyone about this, how I've been having some struggles just trying to figure out where to prioritize this particular YouTube channel. And I made the decision to make some trade-offs and just go for it, continue to go for it with this YouTube channel. But I totally understand this rule of 168. I like how they are employing it at RPM International. And so what else about this business? Now, 73% of sales come from North America. And so that's something to be cognizant of. I wish it were a little bit geographically diverse globally. And so that potentially is a con. They are hyper-focused here in the US, but they do have a little bit of international exposure. And I like how they have outperformed the S&P. I guess they have outperformed on a total returns basis the S&P by 27% over the last 10 years. And so this company has 4 segments. I already talked about the consumer-facing segment that produces products like this that we all know from going to our local hardware store. We all know about these brands. And the consumer group is 34% of sales, but they also have construction products group, which is 34% of sales. They have performance coatings group, which is 20% of sales, and a specialty products group, which is 12% of sales. And so those are the segments at the company. And what I want to do now is I want to move into the financials. What does this thing look like from a financial perspective? Check it out on the screen right now. I'm going to go through just some quick overview in terms of the RPM stock, just the basics, and then I'll get more advanced from there. So check it out. And basically, at RPM, the price per share is $74.88. They do pay a dividend. It is 36 cents a quarter or $1.44 per year. So that is an implied yield of 1.92%. So it's a lower starting yield. But as we'll see in a minute, there's a lot of room to grow it. And quite frankly, with a company that has grown the dividend for 46 consecutive years, I like to kind of have a lower dividend yield, lower payout ratio, because it gives it room to continue to grow, which is good. Always room to grow. And so the EPS estimate for 2020 is $2.93. The EPS estimate is $3.27 for 2021. So it's not cheap. This thing is priced to perfection on a forward basis. For 2021, the PE is a 22, and for 2020 this year, it's a 25. And so certainly there is no discount in RPM right now. And I don't know, in terms of particular timing, let's say I wanted to add a 47th stock to my portfolio. Would I buy RPM right now? Not for me, but it is solidly on my watch list. And if the thing ever tanks, like it did just back in March, I would have a good look at it again. But it's important, here's a takeaway, is it's important even if a stock like RPM is priced to perfection right now to get the analysis out of the way. Because when the market crashes again, when the market corrects again, is there going to be time in the moment to do this kind of analysis? No. The only time that there will be in the moment is to make the decision, do I buy or do I not buy? And so that is the thing, it's just important to do this type of analysis ahead of time. And so with RPM, they have a payout ratio in 2020 of 49%, 2021 of 44%. So it is a lower payout ratio, a lot of room to grow that dividend, which is so important because for someone who does not need to retire tomorrow, for someone like myself who will retire and live off of passive income in the future, I like stocks like this that grow the dividend because it tends to optimize my yield on cost over the long run. And look, I have a good mix of current yielders and dividend growers. This one clearly goes into the dividend growth category. It is a lower current yield, but huge opportunity for yield on cost in the future. And so the market cap of this company is also smaller. It has a $9.7 billion market cap. I like that because it kind of plays a sweet spot. I don't have too many of those smaller kind of companies in the portfolio. Most of my companies are large caps, if not mega caps. And so there's something to be said about having diversification by market cap. I like that it has a smaller market cap, but not too small either. This is a solid company, almost $10 billion in market cap. And so I want to go into the dividend history now, the dividend growth. I'll share that on the screen as well. And this company has been growing the dividend on average for the last 5 years by 6.72%. And so it falls just below my sweet spot. My sweet spot is right around 7, and I like picking a 7 because it is high enough to get the compounding going, to get the compound interest going, but it is not so high that it is unsustainable. And so it comes right in under that 7% mark that I hold so dear to myself. And so I would say from that standpoint, I really like it. I really like where it's coming in with the dividend growth. Now, also on the screen right now, what you can see is an analysis that I did on how much the price per share has gone up over time, because I was looking at the chart on this thing and it has performed very well. They are in a niche. They are flying under the radar. They are a hidden gem, and they have found this category of these specialty sealants that literally has just done so well for investors. So if you look all the way back to 2000 and you compare it 20 years later, just 2 decades, this thing on average from a price per share basis has grown 10.6% per year on average. I'm not even counting dividends. I'm not counting reinvested dividends, just talking about price per share on average per year over the last 20 years has grown by 10.6% compound annual growth rate. Thug life. That is fabulous. A lot of people think, and that doesn't include the dividend, doesn't include reinvested dividends. To get that kind of capital appreciation, stock price growth, people think they have to go to tech stocks. Isn't it cool that something like that is possible with this? So amazing. And so I want to move on now, and I want to look a little bit closer at the financials of this company. And so what I did is I went to their annual report. I started looking at data. What I'm going to start with actually is some data that I extracted from the income statement. So let me share it on the screen right now with all of you. And so I extracted this data from the income statement. And what I'm doing is I just took the easy route. I'm looking at the last 3 years because that's what was so easy to pull from their income statement. And this is fiscal years, not calendar years. And one of the most important things I noted up front is net sales are steady up and to the right. They start at 4.9 billion, then 5.3 billion, then 5.5 billion. And so they keep going up into the right. And what's so nice is the compound annual growth rate over these 3 years is almost 4%. It's 3.9%. So slow and steady top line growth. It is so important to have that slow and steady top line growth because with financial engineering these days, with share buybacks, it's possible to kind of influence the bottom line, if you will, but the top line is harder to influence. And so top line is really important to me these days, and that's why I highlight it in yellow here for all of you. Now, gross profit has been a little bit slower to grow, but it has been up and to the right, a compound annual growth rate over the last 3 fiscal years of 1.5%. But again, nicely growing each year. One of the things I noticed, quite frankly, is while their gross margin has declined from 44% to 41%, I highlight that 41% because that is a high gross margin. It is nice to see a high gross margin in an industry like this that makes products like this that just, quite frankly, are not very expensive products to purchase. But you'll see in a minute that the net margins are quite low. And so that's something actually that is a red flag to me, or a negative, if you will, with this company. And so net income over the years has bounced a little bit. It's 184 million up to 339, down to 267. And so it's bounced up and down, but we'll get more to this in a minute. It appears to me that the net income is influenced quite a bit by some restructuring costs and by some goodwill impairment in 2017. And so if we look at things later, I don't think the net income is bouncing around as much as it looks like here. It looks to me, when I factor in the goodwill impairment, when I factor in restructuring, when I look at it, or I guess factoring those out, if you will, the net income is more of a steady growth, just like the revenue, which is what I like to see. And so net margins, there's no doubt about it. This is a lower margin business. It's at a 4.81% in 2019. And so if there was something that bothers me about this business, it is that the net margins are lower. Now, I don't fault them for that, though, because I think it comes with the territory. When you're selling these types of products, I don't think it's possible to expect a very high net margin. It's just not a very high margin business, and that's quite frankly why I was kind of impressed that the gross margin was so high. Now, The other thing that bothers me is in isolation, if the net margin were this low, that would be fine. But it's also coupled, I would say, with a reasonably high debt load for a company of this size. And so that's something else that concerns me a little bit. But there's nothing perfect with any company. Any company, even my number one favorite stock of all time, Johnson & Johnson, that one has some challenges with lawsuits and with potential lawsuits against the company. So there are no kind of perfect companies, if you will. And so I'm pointing out the negatives here, but it's just important as an investor to have a balanced opinion. Certainly, I don't feel comfortable buying this at a PE of 25, but if it were at a PE of, say, 15 or 18, I would probably take a pretty good look at it, and I really like what I'm seeing here. And so earnings per share are up. They go from $1.36 to $2.50 to $2.01. And so again, it bounces around a little bit, but over the 3 fiscal year period, it is trending up. And again, I think that is influenced by some of this wacky stuff that's going on as well in terms of impairment and such. All right, now that we've looked at some of the basics from the income statement that I extrapolated from the income statement, I want to share the entire income statement with you on the screen right now because there's some good insights about this company when you see all of the details. So check it out. And one of the things that you can see right away at the top is, again, gross profit is really high. And so the cost of making these products, it's not that bad. It's not that bad. But the net margins are really low at the end of the day because you can see that selling, general, and administrative is really high. And so I guess when you're selling products like this, to get it into the store like Home Depot, to sell it business to business. By the way, I own Home Depot and I love that stock. I guess those expenses are just extraordinarily high. And so I thought that was really interesting to see. It's just an interesting nuance about this business. The net margins, I would have thought, hey, maybe it's just low because it's low cost products and such. But it's not only that, it's because the SG&A is high. And so what you also see here, as I had just mentioned, there is this $42 million restructuring expense in 2019, and there's a $17.5 million in 2018. And that what you also see is there's a huge goodwill and asset impairment in 2017 of $193 million. And so the key thing here is when you drop to the bottom line, net income in 2017 was $181 million. But what if there was not this 193 impairment charge? The net income would have been a lot better, and so it wouldn't have been as low as it looks. And then you think, why is net income lower in 2019 than it was in 2018? Well, if it didn't have this huge restructuring charge, I guess it still would have been lower, but it would be looking pretty darn good. And so just worth saying that this is why I'm placing a lot of emphasis here on the top line, because looking at the bottom line, it's kind of wacky right now, but I believe that in general, over long periods of time, based on what I'm seeing here, is it probably smooths out a lot better than in these few 3 fiscal years that we're looking at right now. And so what I want to do next is I want to move on and I want to quickly look at the balance sheet of this company. So let's start with the assets. I'll share it on the screen right now. And in terms of the balance sheet, what I noticed is off the bat, the cash and cash equivalents is only $200 million. So it's not that high. Something else worth noting is that Goodwill is pretty darn high. Goodwill is $1.2 billion. And so the high Goodwill, what that tells me is that they're making a lot of acquisitions. And so when you have a goodwill that is higher, usually how this works is if you make an acquisition and you pay for it higher than the book value of the company, the rest is carried as goodwill on the balance sheet. And so by having a goodwill in this range, it tells me they've made a lot of acquisitions, especially when this is a $10 billion company and they're carrying $1.2 billion of goodwill on the balance sheet. But what we also know is, wait a minute, Ian, they just had all these restructuring charges. Wait a minute, Ian, you just showed us that they had this huge impairment charge in fiscal 2017. And I'm going to bring that back up again because that was on the income statement. And so when I bring the income statement back up, yeah, asset impairment in 2017 of $193 million, restructuring charges of $43 million, and more goodwill impairment in 2019. And so what you see right now in front of you on the income statement again is, it's so interesting to connect these dots. And when I look at this type of analysis, this is why I say, look at this number, remember this number, because they all kind of connect. And what I'm starting to see is they make a lot of acquisitions and sometimes they're not panning out. Now, is this a deal killer? Does it mean that this is not a good company for me? No, but it's something worth noting that not all of their acquisitions are panning out the way they thought. Now, while I'm back on the income statement again, one thing I also want to point out is they have something on here about interest expense. I guess that's probably the cost of debt. $100 million a year. Now, if you drop all the way to the bottom line, in 2019 at least, they made $266 million. As compared to their bottom line net earnings, interest expense is reasonably big for this company. Now, I'm going to go back to the balance sheet, and as I go through the balance sheet, you will see that. You'll see why. They're actually carrying a good amount of debt. So again, it's connecting dots between income statement, balance sheet, cash flows, so on and so forth. And so I want to bring the balance sheet back up now. So check it out. And what you see here is, well, first we'll finish with the assets side of things. The total assets of the company, as you can see on the bottom, are $5 billion. And again, they only have $200 million cash. And so they only have 2 years worth of debt there in cash. That's something worth pointing out as well. I wish they had a little bit more, but maybe it's such a predictable company that they don't feel they need to carry too much cash. But that's the assets side of the balance sheet. What I want to do now is go to the liabilities side of the balance sheet. So check it out. And what you see here is, bam, long-term liabilities at $2.493 billion. The reason I'm pointing this out is they have a lot of long-term liabilities. It makes sense. That's why the interest expense that we saw just on the income statement is reasonably big in terms of scale as compared to their net income, for example. It's a good size line item. The reason it's a good size line item is they got a lot of liabilities. Now, to have $2.493 billion in long-term debt for a $10 billion company, it's reasonably big. It's not too bad, but it's up there. Now, what I do like to see is it's coming down in the last 2 years that are compared here. I guess year 18 versus 19, fiscal 18 versus fiscal 19. It did drop from 2.6 billion to 2.493. I like the trend. It's going down, and so that is something good. They're managing their debt. They're trying to get it down. Seems like they made some acquisitions, and now they're trying to get the debt paid down over time. Worth noting, I don't put a lot of value on it unless I am dealing with bank stocks or insurance stocks, but they do have a positive shareholders' equity here on the balance sheet. And so this is going to be a quicker analysis today, but what I want to do next is I want to start synthesizing all of this. And so I want to start first with some of the pros of this, the benefits, if you will, of RPM International. And so check it out on the screen right now. And what I'm seeing with RPM International is it's an under-the-radar business. I love under-the-radar businesses. I use their products, which is great. I think they're essential products in any economy. People are always making renovations to their home, improvements. They have to protect physical property. most physical property in commercial real estate, for example, is going to be on a maintenance schedule. And just because the economy is bad, you're not going to stop maintaining your physical property. You're not going to let it go because you know the value that's there. And you know if you delay those maintenance items for a year or two, that it's going to cost you so much more in the long run. And so I do like this type of business because it is, I believe, one of those businesses that has some immunity against economic cycles. Not total immunity the way maybe Johnson and Johnson would, but certainly has some immunity. And what else do I like about this business? They have a history of growing the top and bottom lines. I especially like seeing the top line growth because I know the bottom line will follow. I know the bottom line is bouncing around a bit in the numbers we saw today, but I know it will generally follow over the long run. It has a history of beating the S&P. It has a low payout ratio, so there's room to raise that dividend even more. And I would say the company cares about their dividend. They actually highlighted on their website that they care about it in their annual report. They care about it. So that's what I like about RPM. Now I want to move into what I don't like about RPM based on the analysis today. And so check it out on the screen right now. And I don't like the low net margins. It was, even as I was going through this today, I was like, oh, of course the net margins are low. It's because they're selling lower priced items and the margins just aren't that high. But what's funny is as I was going through the video, I even caught myself. I was like, oh, wait a minute. Gross margin's pretty good. So the cost of making this stuff, it's not as high as I would have thought. The gross margins are fine. And so the reason the net margins are low is SG&A is so high. And it begs the question, why is SG&A so high? And so if you know that, put in the comments below. I don't understand why the net margins are so low. I guess it's probably just a function of selling this kind of product. And look, when I go to Home Depot, there is no other caulking. It's only this DAP brand. I think at least that's all I see. I see DAP of a million different variations. And so it might be that to get it like that, so that they're kind of the only choice, there's a lot of sales that goes into it. There's a lot, and it's high price salespeople, and it's a lot of sales. That's what I'm deciphering, but it's so interesting that SG&A is so high. And so that's a downside. I don't like all this restructuring cost and impairment cost. It's a sign of bad acquisitions. I don't like the higher long-term debt, but it is nice to see that it's coming down. And then I just think, would it be easier for me to buy more 3M? I already own 3M. It's a bigger company. It's in a similar space. And so I also own a company called Air Products and Chemicals. And so I do have some exposure to chemicals there as well. And so I start thinking holistically from my portfolio. I got exposure to home improvement because I own Home Depot. I got the store. Now, I got exposure to all kinds of stuff, adhesives and such, because I own 3M. I got exposure to chemicals because I own Air Products and Chemicals. And then it begs the question, Ian, do you need this? Do you need to own this stock to have even more exposure? I would say I'm very open to it. After everything I've seen so far, I would say I need to dig a bit further. Homework for me on this, I would say, is I don't have a great handle on the bottom line. Even as I was going through the video today, I had to stop literally and go back and start digging through the numbers again because I was kind of talking and then I was like, wait, what I'm saying here isn't even making sense to myself. And so I had to dig into it more. And what it came down to is when I look at their financials, the net income is bouncing around. But it's trading at such a premium level and the stock is going up and to the right. And so what that generally tells me is because I believe the market is mostly efficient in the long run, not as much in the short run. What it tells me is that I'm probably missing something on the bottom line and I just need to look at more years of data. But I need that level of comfort before I would go ahead and add this to my portfolio. But I would say from a top line level, from a dividend level, from a product market fit level, from something I believe in, from growing the dividend 46 consecutive years, from kind of the size of the company, if I were to add a position to the portfolio, another one, number 47, it would kind of be something in this size. And so I think it is a hidden gem, quite frankly. I like this kind of business. It flies under the radar. There's a lot to love. I can see why Sam brought it to my attention. And Sam is a proponent of this particular business. Thank you, Sam. I would have never known about this if it were not for you. And I imagine many people watching, same thing. So this is the power of our community here. Love you all. Hope you enjoyed the video today. And please, please give me a thumbs up, a like. It means the world to me. Subscribe, comment. All of that means the world to me. I now have a Patreon. I will link in the description below. Please support me on Patreon. I am giving everything I have into this YouTube channel. I am upping my video frequency. I am going all in, and I am doing that because of my faith that things are going to scale, and this channel will make it to even greater heights than it is at now. And one of the ways I continue to scale is thanks to all of your support. I provide my best content here for free on YouTube. And I love doing that because it is accessible to all. This is dividend investing for everyone. And those who can afford to support on Patreon and who are doing so, bless you all. Thank you so much. It means the world to me, and it really motivates me to do even more with this channel. And so thank you. Thank you so much. Check it out on Facebook. I have a private Facebook group as well. All right, everyone, before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market, please consult a licensed financial advisor first. Investing in the market carries great risk. It is possible to lose a lot of capital. My videos are complete with my personal journey, which may include some mistakes along the way, but I do my best to share as I see it here on YouTube. In terms of a full disclosure, I own some of the stocks mentioned today. I am long 3M, ticker symbol MMM, the Home Depot, ticker symbol HD, and Johnson & Johnson, ticker symbol JNJ. I own all three of those in my personal dividend stock portfolio. All right, everyone. Thank you again for watching. Please, please go ahead and like the video, comment below, share below. If you've ever used a DAP product before or one of the products from RPM International, do you think it's a hidden gem or not? Share in the comments below. Personally, my takeaway again is I think it is a hidden gem. It's solidly on my watch list. I need to learn more about it. I could possibly see myself buying this stock at some point in the future. I'm not quite there yet, but I better be there if I plan on buying it when it gets cheap again. So I'll do a little more analysis. All right, everyone. Have a wonderful day.